Folks, if you're looking for a stock that can turn your small investment into 10x gains in just a few months, then this video is definitely for you. Because I have been keeping my eyes on 3 penny stocks under $5. They're doing quite well despite broader market volatility and economic uncertainty. And these are not just random selections. These are companies backed by solid fundamentals, clear growth strategies, and strong analyst confidence. They've demonstrated operational resilience and are now positioning themselves for explosive rebounds. In a world where market sentiment can change overnight and small caps are often overlooked, these under-the-radar stocks could be the key to unlocking major portfolio gains. So if you're serious about investing and want to position yourself for massive gains, then make sure to watch this video till the end and remember to subscribe and turn on notifications so you never miss an update on the hottest stocks in the market. Let's aim for 100 likes on this video so more people can reach and benefit from this info. That said, let's get into it. The first stock on our list is SurgePays Incorporated, trading under the ticker symbol SURG on the Nasdaq. This is a name that has recently come under the radar of both analysts and retail traders alike because of its impressive pivot strategy and sector-specific relevance. In the past 1 month alone, SurgePays has shown a mixed performance, starting at around $2.60 and gradually climbing up to $2.94 by early June. That's roughly a 13% upside in 30 days despite weaker overall market sentiment. It's clear that the market is slowly digesting its recent changes and giving the company some credit for its ongoing transformation. SurgePays Incorporated is a US-based fintech and telecom company that is focused on providing financial and wireless connectivity services to underserved communities, especially the underbanked population. SurgePays operates mainly through 2 segments. One is its mobile virtual network operator, MVNO, business, where it resells wireless services under its own branding, and the other is its comprehensive platform services segment, which includes a proprietary fintech platform that serves thousands of independent retailers, convenience stores, and corner shops. This platform enables store owners to offer prepaid wireless services, utility payments, and other financial transactions to local customers, many of whom do not have traditional bank accounts. The company's mission is rooted in financial inclusion, aiming to empower the communities that traditional banks and telecom giants often overlook. That unique angle has become especially important in today's economic landscape, where financial inequality and digital access gaps are being addressed on both federal and corporate levels. Now, while SurgePays faced some significant turbulence in fiscal year 2024, especially due to the abrupt end of the Federal Affordable Connectivity Program, it's how the company responded that really deserves attention. Revenue declined sharply to $60.9 million in 2024, a significant 56% year-over-year drop. The Affordable Connectivity Program, also known as ACP, had been a key revenue stream, and its shutdown certainly created short-term financial headwinds. But SurgePays didn't just stand still. Instead, the company decided to realign its entire business model by focusing more aggressively on its in-house solutions like LinkUp Mobile and Lifeline, which are designed to replace ACP and target similar low-income populations with discounted wireless services. These offerings are more sustainable from a business standpoint because they rely less on federal funding and more on recurring customer revenue, which provides better predictability in cash flows over the long term. One of the most promising developments for SurgePays recently has been the performance of its comprehensive platform services segment. While the overall revenue took a hit, this particular segment actually grew substantially, climbing from $11.3 million in 2023 to $17.4 million in 2024. That's a near 54% year-over-year increase in a segment that represents the company's own proprietary platform services for retailers and independent sellers. It's a strong signal that this business model is working and scaling even in a tough market. That kind of resilience is exactly what investors look for in small-cap companies trying to stabilize and grow. From a financial health perspective, the company's recent Q1 2025 earnings were a mixed bag. Revenue for the quarter came in at $10.6 million, down significantly from $31.4 million during the same period last year. However, this is expected due to the ACP wind down. What really matters is the trajectory of its platform revenue. In Q1 2025, platform service revenue was $8.3 million, which is more than triple the $2.5 million reported in Q1 2024. This shift indicates that even though total revenue has dropped, the high margin and recurring revenue streams are gaining traction. Unfortunately, The bottom line was impacted heavily by restructuring costs and reduced scale. SurgePays posted a net loss of $7.6 million for Q1 2025, equating to a loss per share of 38 cents. Gross profit also flipped negative, registering a loss of $2.9 million compared to an $8.2 million profit in Q1 2024. However, the company is tightening its belt. Selling, general, and administrative expenses dropped 28.6% year-over-year to $4.4 million, a reflection of the company's efforts to streamline operations and reduce cash burn. In terms of liquidity, SurgePays ended the quarter with $5.4 million in cash and equivalents, which is down from $11.8 million at the end of 2024. To shore up its financial base, the company secured a $6 million financing facility with a steep 15% interest rate, maturing in 24 months. While the cost of capital is high, the infusion gives them some breathing room to execute their strategic plans without short-term solvency concerns. Investors should keep an eye on how this capital is deployed over the next few quarters. The cherry on top is the fact that SurgePays has recently completed its integration with AT&T, which led to the formal launch of LinkUp Mobile. This service is designed to deliver wireless plans to underserved communities and opens up new revenue opportunities through bundling and tiered services. The AT&T partnership not only lends credibility, but also significantly expands the company's network capacity and scalability. With a current share price of $2.94 and a one-year analyst upside potential of over 113%, SurgePays stands out as one of the highest-rated penny stocks on Wall Street right now. This isn't just speculation. Analysts are making these calls based on strategic pivots, improving core business metrics, and visible growth levers that can be activated in the next few quarters. The second stock on our list is HF Foods Group Incorporated, trading under the ticker symbol HFFG on the Nasdaq. Over the past month, HF Foods has been relatively stable, moving between $3.70 and $3.82 with minimal volatility. While this might not seem dramatic, the stock is holding its ground in a sector that has faced persistent inflationary and supply chain headwinds. That kind of consistency is a positive signal for a small-cap food distributor that operates in a niche but expanding market. HF Foods Group is a national marketer and distributor of fresh, frozen, and dry foods specifically targeting Asian and Chinese restaurants in the U.S. What sets the company apart is its focused approach to an underserved but rapidly growing demographic. The company has strategically built a logistics and distribution infrastructure that connects over 15,000 restaurants and retail outlets across 48 states. From fresh vegetables and meat to imported sauces and specialty ingredients, HF Foods is essentially the backbone supplier for countless mom-and-pop restaurants and fast-growing Asian cuisine chains. With the growing popularity of Asian food and rising consumer demand for authenticity, HF Foods sits at a strategic intersection of culture and commerce. Financially, HF Foods has had a solid run. In the fourth quarter of 2024, it posted $305.3 million in revenue, an 8.7% increase from the year-ago quarter. This was driven by new wholesale account wins and improved category-level pricing. But what really impressed analysts was the company's ability to cut costs while growing the top line. HF Foods managed to reduce distribution, selling, and administrative costs as a percentage of revenue, which helped protect margins. These operational efficiencies demonstrate strong managerial discipline and provide more cushion against economic volatility. In Q1 2025, the company continued this positive trajectory. Net revenue came in at $298.4 million, a slight 0.9% increase compared to the previous year's $295.7 million. While not explosive growth, it's still growth in a sector that has seen contraction. More importantly, gross profit rose 1.1% to $51 million, and margins remained flat at 17.1%, reflecting stable input costs and effective pricing strategies. Adjusted EBITDA rose 12.3% year-over-year to $9.8 million, a sign of healthy operating leverage. However, the bottom line did take a hit. HF Foods posted a net loss of $1.5 million, up from a loss of $0.6 million in Q1 2024. This was largely due to unfavorable movements in interest rate swap contracts, essentially a non-core, non-cash financial adjustment. So in practical terms, the loss isn't indicative of deteriorating business health. What's exciting about HF Foods is its forward-looking strategy. The company is actively diversifying away from the traditional restaurant segment by moving into specialty groceries and e-commerce. These are both high-growth channels that can deliver higher margins and more customer data for targeted offerings. As inflation continues to pinch restaurant margins, HF Foods' pivot into these adjacencies gives it more room to grow sustainably. With a current stock price of $3.82 and analysts forecasting a 75.44% upside, HF Foods appears to be a well-positioned penny stock for investors seeking stability with growth upside. The third and final stock on our list is TMC, the Metals Company, Inc., listed under the ticker symbol TMC on the NASDAQ. This one's a bit different from the first two because it operates in the highly specialized and futuristic sector of deep-sea mineral exploration. Over the last month, the stock has moved from about $3.90 to $4.21, posting a roughly 8% gain. That's not earth-shattering, but it's noteworthy given the speculative nature of the business and the volatility in the commodities market. TMC is targeting the ocean floor for polymetallic nodules, rock-like mineral deposits that contain high concentrations of nickel, cobalt, copper, and manganese. These metals are essential inputs for electric vehicle batteries, renewable energy storage systems, and various advanced technologies. As the global energy transition accelerates, the demand for these minerals is skyrocketing. Unlike traditional mining companies that extract from land-based reserves, TMC aims to collect nodules from the seabed, which offers a more sustainable and potentially less environmentally destructive alternative. One of the biggest challenges for TMC has been regulatory uncertainty. Originally, the company was banking on the International Seabed Authority to adopt a new mining code that would allow for large-scale commercial operations. However, delays and geopolitical debates slowed progress. In response, TMC decided to shift toward pursuing permits under the U.S. Deep Seabed Hard Mineral Resources Act. This strategic pivot provides a more defined legal framework and could accelerate the company's path to production if approvals come through as expected. Financially, TMC is still a pre-revenue company, which means its value is largely derived from its intellectual property, asset base, and strategic positioning. In Q1 2025, TMC reported a net loss of $20.6 million, or 6 cents per share. While losses are expected at this stage, the company maintains solid liquidity with $43.8 million in total funds, including $2.3 million in cash. It has also increased its ERAS/Barron facility from $38 million to $44 million, giving it access to $41.5 million in fresh capital. At the same time, it terminated a $25 million facility with Allseas Group SA by mutual agreement, indicating a shift in financing strategy. These moves show that the company is actively managing its balance sheet and financing needs while it advances its exploration and permitting efforts. At a share price of $4.21, and with analyst targets pointing to strong upside potential, TMC could be a sleeper hit in the broader EV and green energy supply chain. Investors willing to take on some speculative risk for outsized returns might find TMC an intriguing addition to their watch list. To wrap things up, all three of these penny stocks, SurgePays, HF Foods Group, and TMC, the Metals Company, offer unique value propositions in completely different sectors. Whether it's a fintech platform expanding into underbanked telecom, a niche food distributor scaling across America, or a cutting-edge metals explorer harvesting the ocean floor, these companies are not just about hype. They're about transformation, strategy, and real growth potential. So if you're looking to 10x your money and are serious about spotting high upside opportunities early, these three picks deserve your close attention. Don't forget to subscribe and turn on notifications so you never miss an update on the next big thing in the stock market. Thanks for watching, and I'll see you in the next one.